Good morning, one and all. So, today, this is the time that we have to start with the theories of capital structure. It is very important topic under the financial management. So, I think the students are familiar with the term, with the different terms of the financial management. And today's session will cover about the theories of capital structure. So exactly what is the need of capital structure, or what is the capital structure which is required within organization, and the finance manager will take the responsibility to build the capital structure. So first of all, the student should be aware of the capital structure. Then it comes to the theories of capital structure. Because if you are not familiar with the term capital structure, you cannot understand or you cannot develop the sense of the theories of capital structure. And the theories of capital structure, no doubt, is very important under the financial management. When it comes to earn the profit or to maximize the profit in the organization, or we need to increase the EPS, earning per share, of the shareholders, so that time we need to consider the theories of capital structure, right? So what is the capital structure? No doubt, when we have to invest the capital in the business, we need the different sources, or we consider the different sources of capital or the finance. As you see that some of the firms are issuing the shares in the market, and some are issuing the debentures, or they are using the debt capital along with the equity capital. It means they are making the proportion of the debt capital as well as the equity capital. So when there is a composition of the different sources of finance, when it comes to invest the capital in the business, and there is a question how to raise the capital. So if the particular firm is raising the funds from the different sources, it means we are investing the capital by raising the fund from the different sources. That is composition of capital structure. Capital structure is nothing but it is the proportion of the different sources of fund or different sources of capital. So capital structure, now you are familiar with this particular term, right? And what about the theories of capital structure? Why we are maintaining the capital structure? Why there is a need to build the capital structure within an organization? The very first question in the mind of the students comes that what is the need of capital structure? Why we are maintaining the ratio between the debt capital and the equity capital, right? So as you know that the equity shareholders are there as the investors, and they are attracted towards the investment in the organization. And preference shares are also there, right? The company can issue the preference shares, company can issue the debentures, company can raise the fund from the bonds also. So what is the particular ratio to be maintained between the debt capital and the equity capital? Because if the particular organization is desiring to increase the EPS, right, earning per share, or is desiring to increase the wealth of the shareholder, that time it comes to the point that we should maintain the ratio between the debt capital and the equity capital. Okay. And another thing is, as you must heard about the leverage. What is the leverage? Because we go ahead with this particular concept of the theories of capital structure, we need to develop the understanding of the leverage also. So if few companies, right, or for example, few companies are taking the advantage of the leverage, they are working on the leverage, they are maintaining the debt capital and the equity capital as a composition of, and they are using both the debt capital and the equity capital along with. So that time we can say that the company is working on the leverage, right? So what is the leverage? When the company is using the debt capital along with the equity capital, that is the leverage, right? Company is working on the leverage. So why the companies are going through this leverage, or why they are using this technique of the leverage into the financial management? Because as we know that there are different kinds of the capital, right? For example, you can say the debt capital, which is known as the cheaper source of finance, right, in comparison of the equity shares. So if you want to reduce the cost of capital, as I told you in the previous lecture, that company has to maintain a cost of capital or has to bear the cost of capital, right? So in order to reduce the cost of capital, we need to select the best option with us, the best alternative in the market where we can go to raise the fund, right? So if the organization, in the context of the organization we are talking about, that if the companies or the businessmen are using the debt capital, right? They are issuing the debentures, right, to the debenture holders in the market. So they are raising the fund through debentures, and there is to be paid a interest, right? It means there is a particular interest rate, and no doubt it is the borrowing fund. So if you are borrowing the money to invest in the business organization, right? And suppose, for example, if you are paying 10% interest on the debentures, right? There is a particular interest rate of 10%, and suppose 12% is the dividend rate, right? It means if you are paying a particular profit, right, a part of the profit to the shareholders in the form of dividend. So dividend is also a cost of capital, right? So if you are paying 12% dividend on the capital as compared to the 10% interest rate on the borrowing funds or the cheaper fund, you can say, on the debentures, so that time we can say that the company is paying high cost, or bearing high cost of the fund in the form of the capital, equity capital. So if you want to reduce the finance cost, if you want to reduce the cost of fund, okay, with your organization, that time you should consider that exactly what is the cost of capital of the different sources of finance, right? So preferred shares, equity shares, and debentures, and number of securities are there. You can issue, you can raise the fund through. So when you have to maintain, if you desire to reduce the cost of capital or the overall weighted average cost of capital within organization, you need to consider to analyze the different sources of the finance, where you are paying a particular interest, where you are paying a particular dividend. So you have to think that which kind of the source of finance is charging more cost, right? So if you want to reduce the cost of capital, you need to analyze the different sources of funds. And now we are talking about that the company is working on the leverage. It means why there is a need to work on the leverage. Because if you are maintaining the ratio of the debt capital and the equity capital, no doubt, in comparison to equity capital, there is a cheaper source of capital, that is the debt capital, and you have to bear a cost in the form of the interest on debentures, right? Less than the cost of equity share capital. So in order to reduce the cost of capital, overall cost of capital, we need to build the capital structure. So what is the capital structure? First of all, I am just trying to give you the sense of the capital structure so that easily you can understand that what are the theories of capital structure and what are the types of theories and how can we use these theories when it comes to build the capital structure within the organization. Okay. So after some time, definitely we will be talking about the theories of the capital structure. But first thing is to clear the sense of capital structure, and no doubt now, I think I am very sure that you are familiar with the particular term capital structure. Capital structure is the composition of different sources of fund like preferred shares, equity shares, and debt. But you can easily take the sense right now that debt capital and the equity capital. Okay, we are talking about two capitals, debt capital and the equity capital when it comes to the capital structure. And in the context of theories of capital structure, exactly what is the theory and what is the need of this theory and what is the importance, you can say, that why we should study the theories of capital structure. Because as you see that in the market, right, when we are issuing the shares, we are issuing the equity shares in the market, and the equity shareholders are expecting a very good return on their investment in the form of the dividend, in the form of the capital appreciation, right? So they want that there should be a good return, right? And on the other hand, if you are issuing the debenture holders are also expecting a good return in the form of the interest. Okay. So exactly what proportion should be maintained within organization of a capital structure? It means suppose 50% shares and 50% debentures if you are issuing. So you are with a good profit making, or you can increase the EPS in the organization. So you should consider whether what particular ratio is the ideal ratio, or what particular ratio should be maintained between the equity and debt capital. So where we can get the more benefit, right? We have to analyze it. So there are different theories, and we have to clear the theories of the capital structure in order to develop the sense of increasing the profitability within organization. So ultimately, aim of understanding this particular topic is that how can we increase the profit? How can we increase the profit which is to be distributed to the equity shareholder, right? And how to attract the investors towards the company where they want to invest in. So exactly, we want to say that the theories of capital structure will focus on the value of the firm, the overall cost of capital, right? And ultimately, or to give an impact to the increase in the shareholders' wealth. So one by one, we would be considering all the concepts of the theories of capital structure in today's session. And there are some assumptions in capital structure theories. So you can see that two sources of funds, equity and debt. As I told you that we have to consider equity and debt, both the capital, when it comes to develop the sense or develop the understanding of capital structure theories. So there are two sources of funds, equity and debt. We would talk about the equity capital and the debt capital as known cheaper capital, right? And we have to bear a particular cost in the form of the interest, right? So we are talking about the equity shares and the debentures. And second point is this policy of paying 100% of its earning by way of dividend. So there is a particular assumption that the companies will pay 100% of their earning by way of dividend. There is no retained earning. It means no any part of the profit would be retained by the companies itself. And total assets of a company are given, and these are not expected to change over a period of time. It means the company is not going to take the decision regarding buying or selling any assets. It means for a longer period, the same assets would be used within organization. And corporate income tax does not exist, because it is very, very important point that because there is a role of the taxes. So numerically, when we will solve it, we will find that exactly what is the role of the corporate tax, right? So if you are using the leverage, if you are working on the leverage, you are issuing the debt capital in the form of the debentures, and you are paying the interest. So after deducting the interest, right, if you are familiar with the P&L account, and of course you should be. So if you are showing the interest on debentures in the debit side of the P&L account, there would be impact that the tax, right, would be deducted over there. So what about the corporate income tax? We are talking about in the context of the theories of capital structure, and definitely there would be an impact of the corporate tax. So here there is a particular sense that corporate income tax does not exist, right? We have to take this assumption in mind when we are talking about the capital structure theories. The operating profit of the firm are given and not expected to grow, right? Business risk is treated constant at different capital structure of a company. It means we have to assume that in a particular company's capital structure, there is a risk, and risk is treated as a constant, right? And there are no transaction costs, and a company can alter its capital structure without any transaction cost very frequently. So we have to assume or we have to keep in mind these assumptions when we are talking about the theories of capital or when we are building a capital structure for any organization. Now have a look on main theories of capital structure. There are 4 theories: net income approach theory, net operating income approach theory, the traditional approach theory, and Modigliani and Miller's approach theory. So these are the approaches when you are building the capital structure, right? Or you are considering the capital structure within any organization. Okay. So what is the net income approach theory? What is net operating income approach theory? Traditional approach theory and Modigliani Miller's approach theory? Is there any difference? Or exactly which particular approach we should adopt when we are considering the capital structure or we are building the capital structure within an organization? So there are some merits, there are some demerits, and when you would be familiar with each and every theory of the capital structure, you can take the decision how to build the capital structure or how to make the proportion of the debt capital and the equity capital, right? So the very first theory, that is the net income approach theory, we will have to look on, and this is the particular approach where this particular approach is given by the Durant David, and capital structure decision is relevant to the valuation of the firm. Again, there is a new term for you all that we have to go for the valuation of the firm. Exactly what is the meaning of the valuation of firm? You must be aware of that. That valuation of the firm means suppose company is issuing the shares and debentures in the market. So overall, what is the value of the entire debentures? Number of debentures, right? What is the value of debentures? And the number of shares which the company has issued in the market to the shareholders. So what about the entire shares? And what is the valuation of the shares? What is the market price? As per the market price of the equity shares, we have to calculate the value of the equity shares. So what about the total value of the firm we are talking about? So capital structure decision is relevant to this valuation of the firm. It means under this particular approach, right, the capital structure decision is considered as a relevant to the valuation of the firm. For example, suppose we have to calculate the valuation of firm. There are 2 capital, right, debt capital, equity capital, and when we are calculating that what is the value of debentures in the firm, what is the total value of the shares which have been issued by the organization in the market. So what about the total valuation of the firm, right? And if the capital structure decision is taken whether we have to issue the debt capital along with the equity capitals, no doubt this particular net income approach describes or the focuses or emphasizes that a particular finance manager should consider the ratio between the debt capital and the equity capital. They should issue both the capital in the market so that there is a reduced cost of capital as well as the increased value of the firm. So capital structure decision is relevant. It means this theory is relevant. If you are changing the ratio of the debt and equity capital, no doubt there would be an impact on the value of the firm. Maybe the value of the firm is decreased or the increase. So we have to look into the capital structure decision, and it is very, very relevant to the valuation of the firm. And a change in the capital structure causes an overall change in the cost of capital. No doubt when you are giving the change, you are giving the impact to the capital structure by changing your debt or equity ratio. If you are increasing the debt capital among the proportion of the capital, right? And the equity shares are reduced over there, or you are going to redeem the equity share, or you are taking buyback, you are buyback the equity shares in the market. So that time you are going to change the capital structure within organization, and there would be an impact on overall cost of, or you can say the weighted average cost of capital. So again, there is a relevance that if you are changing the ratio, definitely there would be an impact on the value of the firm, right? A higher debt content means a higher financial impact. As now you are familiar with the leverage term that the company is using the debt capital along with the equity capital, and the financial leverage we are talking about. If there is a high financial leverage, higher debt you are using in your capital, and this results in the decline in the overall weighted average cost of capital. As I told you earlier, that the particular debt capital is known as a cheaper source of finance. So if you are using this cheaper source of finance as compared to your equity capital, no doubt you have to bear a less cost of capital in the form of the interest we are talking about. So there is a decline in the overall weighted average cost of capital. If you calculate that exactly what is the overall weighted average cost of capital, you will find that by using the debt capital, you can reduce the overall cost of capital of any company. So you have to assume this particular thing, this particular aspect you should look. And the result of the decline in overall weighted average cost of capital will result in increased value of the firm. Once you see that the average cost of capital is reduced, no doubt if there is a reduced cost of capital, there would be more profit in the hand of the firm, and it will result in increased value of the firm. Now it comes to basic assumptions of NI. Right? We have to consider the different assumptions when we are talking about the different theories of capital structure. So basic assumptions of NI approach are the risk perception of the investor. It means when the investors are looking towards the investment in a company, no doubt they are calculating the risk factor. They are estimating exactly the risk of the investment in that company. And on the basis of the risk and return analysis, they would be investing in a particular organization. So risk perception of investor is not changed by the use of debt. Very sincerely, you have to consider this point. Right? There is a particular catch that if you are using the debt capital along with the equity capital, so no doubt when the equity shareholders in the market, they are of the perception if the company will increase the debt proportion, right? So maybe there may be a particular risk of the insolvency, right? In the case of the loss, the particular interest has to be paid to the debenture holders. So if the company is increasing the number of debentures to be issued as compared to number of shares, and they are working on the high leverage, they are increasing increasing the share of the debenture holders, they are increasing the number of debentures. So we can say there should be a particular mindset of the investors, or you can say the mindset of the shareholders, that there is a risk, right? So but there is a particular assumptions under this NI. The risk perception of the investor is not changed by the use of debt. If you are maintaining any proportion of debt and equity, if you are changing the ratio of the debt capital and the equity capital, under this NI approach, net income approach, there would be the perception of investor, and there is no change in the perception. There is a particular perception of the investor that if the company is changing the ratio of proportion, if the company is increasing any number of debentures, there would be no impact. There would be the risk perception of investor is not changed, right? It means there is no more risk. It means the investors or the equity shareholders are of this particular opinion that the company is increasing the debt in the organization, and there would be no impact, or in the context of the risk, there would be no risk if the company is using debt. So the risk perception of investor is not changed. The cost of debt is less than the cost of equity, right? The second point, or the second assumption, is the cost of debt is less than the cost of equity. As I told you that in comparison to the equity share, okay, the debt capital is known as a cheaper source of capital. Okay, because we have to pay the less cost in the form of the interest to the debenture holders. So this is again a second assumption under this approach, that the debt capital is having low cost of capital companies are working on the leverage in order to increase the profitability to the shareholder. And third one is the corporate tax does not exist. As I told you, there is a particular rule. If you are using the debt capital, it will be shown in the form of the interest as a cost of capital in the P&L account debit side. And when you will be calculating the tax, there will be a particular impact. So we are talking about these basic assumptions, right? I think now you are clear with all these three assumptions. The very first is very important. No doubt, important. Both the first and second are important, but not least the corporate tax does not exist. You have to consider when we are talking about the NI approach. So the very first, again, I would like to repeat so that you can easily understand this particular theory of net income approach. That is relevance theory. You can say in order to increase the profitability, it means the company is using debt capital and the equity capital. Both the capitals are being used, right? And risk perception of investor is not changed by the use of debt. They are not of opinion that the risk would increase in the company, and they are very much satisfied whatever they are earning, right, in the form of their dividend or the rate of return. And the cost of debt is less than the cost of equity in the context of the cheaper source of capital, right? So these are the basic assumptions you should consider when we are talking about the NI approach. How to calculate the value of the firm and what about the formulas? You can easily have a look. Value of the firm on the basis of NI approach. Value of the firm, that is mentioned by the V, equal to market value of equity. That is the S, and market value of debt, as I told you, but in the form of the formula you can write down. And market value of equity as equal to earnings available to equity shareholders, and it is divided by the equity capitalization rate, that is the KE. So you can calculate. Suppose you want to know exactly there is an impact on the value of the firm. So how will you measure that there is an increase in the value of the firm? There is a reduced overall weighted average cost of capital. So you should go for the numerical, and you can easily calculate on the basis of by applying these formulas towards calculation of the value of the firm, right? So value of the firm will be calculated by using this formula, and I just want to tell you that what is the market value of equity, that is the S, and market value of debt, right? So you can calculate the value of the firm, right? And if you see that there is an increase in the value of the firm, because we are talking about the NI approach, that is very relevant towards the changes or to maintain the ratio of debt and equity. It means this particular theory or this particular approach is describing that a company should maintain a ratio of the debt and equity capital and should work on the leverage in order to maximize the earning to the equity shareholders, because the company, if the company is using the debt capital along with the equity capital, and the first capital is a cheaper source of capital in comparison to the equity share capital, so there would be the less cost of capital and resulting in the increased profitability to the equity shareholder. And the second thing is the value of the firm, because when the shareholders will see that there is a less cost of capital with the organization, they would be more attracted toward the investment in the organization, and there would be high cost of high value of the firm in the market, right? And the second theory or the second approach is the net operating income approach. Again, this is suggested by Mr. Dhruv, and this is just opposite to the NI approach. Yes, it is very important. This is very important to say that both the theories are opposite, right, to each other. And the very first theory, now you have considered NI approach and net operating income approach theory is describing that the change in capital structure does not affect the market value of the firm. It means you can see the irrelevance, right? The change in capital structure structure, be it any ratio, be it 50-50 ratio of the debt capital and the equity capital. Maybe there is a ratio of 40 or and 60%, right? So the change in capital structure does not affect the market value of the firm. The market value will remain the same whether the company is taking the decision to change the ratio or change the proportion of the debt capital and the equity capital. The overall cost of capital will also remain constant irrespective of the methods of financing. What kind of the method is applied over there for financing in the firm? There would be a particular cost of capital and it will remain constant. What does it mean? Exactly, we have to take this sense that if the company is issuing the debentures, there is a particular cost of capital in the form of the interest, right? Or you can say interest-bearing finance is being used by the company. And company is also issuing the equity shares, right? And the dividend is to be paid. So both the capital sources will have a particular cost. And overall cost of capital, if you calculate, you will find a particular result, right? So we have to focus when we are using these approaches towards making capital structure decision, right? So if you are, suppose you are the finance manager in an organization and if you want to take the decision regarding the capital structure, right? So and you are planning that we should use the debt financing along with the equity. So first of all, you should analyze whether there is a particular benefit or there is more risk, or maybe there is a particular result that the shareholders are going away from your organization, right, without making the investment, or they are withdrawing their investment from your organization because of the risk perception. If the risk is high by using the debt in the company, so we have to analyze according to this theory. The very first theory describes that there is a relevance. If you maintain a proportion of the debt capital and the equity capital, you will find that the shareholders will have the perception of less risk, right? And because we are using the cheaper source of capital, there is a less cost of capital and the value of the firm is increased. So we have to focus on value of the firm. We have to focus on the overall cost of capital, weighted average cost of capital, right? And we have to focus on the perception thereby of the investors. Okay. So this particular net operating income approach theory is opposite to the NI theory, right? In which way, no doubt, the change in the capital structure does not affect. It means this theory describes the organization, right, in any way is adopting or applying any method of financing, whether they are maintaining 50% debenture or 50% equity shares in the organization, or they are maintaining 40-60% ratio. So it will not give any effect, right? It will not give any effect to the market value of the firm. The market value of the firm will remain constant. You can calculate by using the formula, right? The overall cost of capital will also remain constant. So exactly what is the benefit? Why we are using the debt capital along with the equity capital? Why we are in the need to maintain the debt and equity proportion when there is a particular gain, the more gain, right? So is there any chance, right? So we have to consider, we have to analyze that both the theories are different. Both the theories are describing that in a particular way. The first theory is describing that the organization should use the debt capital, should work on the leverage, and the second theory is denying. Second theory is differ from the first theory and it is opposite to the first theory, and it describes that the organization in any way is using any proportion of the debt or is working or not working with the debt capital, with the leverage. So there would be no any change in the value of the firm. There would be no change in the overall cost of capital. So we have to keep in mind 2 points, right? The very first point is the value of the firm, and second is the overall cost of capital. If the value of the firm is increasing, so no doubt the wealth maximization is there. The more investors would be attracted towards investment in the company, and if the overall cost of capital, right, is less, so no doubt the finance cost is less. So in order to make the competitive advantage, you can once you reduce the cost of finance, overall cost of production would be reduced over there, and you would be selling your product at a very competitive price in the market and making the more profit, right? So this is the particular technique we are using. So it is very, very important when we have to consider whether we have to go for using the debt capital within organization or not. So on the basis of these theories, you can easily take the decision regarding the capital structure changes. If you are planning that we should use this particular proportion of the debt capital, or you think that that debt capital definitely will result in the loss in the company, or the risk perception of the investors would change, right? And there would be no attracted towards investment in the company. So that time you can take the decision that we should not go for adopting this particular method of financing, right? So what is the net income approach theory, and what about the net operating income approach theory? So I think I am very sure that you are aware of both the theories, net income approach theory and net operating income approach theory. And there are some also assumptions of this particular theory, and you can have a look on that. The overall cost of capital remains constant, right? As we have already discussed about it. The market capitalizes the value of the firm as a whole, and therefore the split between debt and equity is not relevant. As I told you that there is no any relevance about the debt and equity proportion. And the use of debt having low cost increasing the risk of equity shareholders. Yes, on this particular point, I would like to discuss that how or in which way the perception of the equity shareholders will change, how they are perceiving when the company is using the debt capital along with the equity capital, or they already have issued the debentures along with the equity shares. That if the company is taking the decision to increase the higher debt proportion, right? They are planning to issue the more debenture holders, more debentures, right? So how the perception of risk is changed, how the perception of investor, the equity shareholders is changed, right? When they look, or when they observe that the company is issuing more debentures and there would be more risk. How? Because as I told you that in the case of the loss, the company is having this responsibility, or has to meet the obligation, the financial obligations, by paying the interest to the debenture holders, even in the case of the loss. So the shareholders will think that there is a fixed liability of the company. The company will have to pay the particular cost of debentures in the form of the interest, right? So they would have the perception that now the company is having the very riskier proportion of the capital structure, and there would be more risk. And no doubt, when the risk is high, the investors in the company will expect more return on their investment, and if the company is not paying as per the expectation, they will leave the company, they will go away from that company, and they will not invest in that particular company. So we can see that this is the risk perception of the investors in a particular company, when they see that the company is taking the decision to make the high proportion of debt along with the equity shares, right? So the use of debt having low cost, increasing the risk of equity shareholders, and this result in increase in equity capitalization. And what about, again, there is a new term, that what about the equity capitalization? You can see the cost of capital, you can see the rate of return, you can see the hurdle rate, or the expected rate of return the shareholders are desiring to have with the organization, right? And there are no corporate taxes. Last but not least, this is again the assumptions of the NOI approach, and on the basis of these assumptions, this theory works. Value of the firm under NOI approach, right? As in order to you can say the calculate the value of the firm under this particular approach. There is a formula that value of the firm equal to EBIT divided by cost of capital, overall cost of capital, right? And V stands for the value of the firm, and EBIT net operating income, or you can say the earning before interest and tax. Now we come to the traditional approach. As both the theories are giving the extreme impact, or you can say the themes, extreme themes, that the company should not go for using the debt capital, should not go for working on the leverage, or the company should go for having higher debt ratio, because there is a impact, or you can say both the theories are different, and both the extreme levels are displayed by both the theories that we have discussed. And this particular traditional approach is an intermediary approach. You have to focus on this particular term, intermediary approach, which reconciles NI and NOI approaches. It partly contains features of the both the approaches as given below. So both the approaches as the NI and NOI. These are the theories. So this particular traditional approach will take, or you can say, will give you a particular, will help you in the decision making of the capital structure. So the traditional approach is similar to the NI approach to a particular extent, that accepts that the capital structure or leverage of the firm affects the cost of capital and its valuation. You can see the traditional approach is similar to the NI approach to a particular extent, that accepts that the capital structure of leverage of the firm affects the cost of capital, right? And its valuation. However, it does not subscribe to the NI approach, that the value of the firm will necessarily increase with all the degree of leverage. Okay. And second, it subscribes to the NOI approach, that beyond a certain degree of leverage, the overall cost of capital increases, results a decrease in the total value of the firm. Okay. However, it differs from the NOI approach in the sense that the overall cost of capital will not remain constant for all the degrees of leverage. So when the company is taking the decision regarding the capital structure proportion, right, or they are using the debt capital in any proportion, so this particular traditional approach will guide them that to which extent they should use the debt capital along with the equity capital, so that to ensure there is no more risk perception of the investors, and to a particular extent, if they are using the debt capital along with the equity capital, they can take the advantage of it. Okay. And now Modigliani and Miller approach. There is the fourth theory or the fourth approach. So this particular approach is identical with net operating approach. Okay. So this approach is identical with net operating approach if taxes are ignored. As I told you that there is a particular role of corporate taxes, right? So assumptions were there that the corporate tax does not exist. So if the taxes are ignored, this particular approach is identical with the net operating approach. However, when corporate taxes are assumed to exit, their hypothesis is similar to the net income approach. So Modigliani and Miller's approach is that capital structure theory, which take both the theories, NI approach and NOI approach, but they consider that the taxes, the role of the taxes, once if the taxes are ignored, you can say that it is identical with the net operating approach. Okay, and if the taxes are assumed to exit, their hypothesis is similar to the net income approach, right? So both the theories, net income approach theory, net operating income theories, both the theories are considered, but in the context of the corporate taxes, right? So now you are familiar with both the theories, right? And third theory and fourth theories again. And what are the assumptions of MMM? We have to take a look on the assumptions of MM approach also. The very first is the capital markets are perfect. It means when the institutions are issuing the securities in the capital market, so what kind of the market is there? Capital markets are very perfect and investors are free to buy and sell their securities. There are no restrictions and frequently they are buying and they are selling their securities in the secondary market, and the investors can borrow without restriction on the same terms on which the firm can borrow. The investors are well informed. Every bit of information is kept by the investors, and they are very much informed about the situation, about the particular market conditions, and they can take the decisions accordingly. And investors behave rationally if the market, the overall market is going down, and on the basis of the information about any company, any organization, they can analyze the situation and accordingly they can invest in the company, or they can withdraw their money, withdraw their investment from the company, and there are no transaction costs, right? Because if there is a particular transaction cost, right, or the high cost we can say, so that time the investors would be restricted, right, to buy more shares or sell their securities. But when you see that there is no transaction cost, they can easily move out, right, from any investment, or they can easily enter into the investment. So that time, if they are very convenient, the investors are very convenient about with their investment in a company, or they can take the decisions regarding buy or sell their securities very easily, very conveniently. So we can say the capital markets are very perfect. Okay. So in that time, the investors are not restricted towards making the investment or towards withdrawal of their investment in the company. So these are the assumptions, right, of the MMM rule. And the second is the firms can be classified into homogeneous risk classes. All firms within the same class will have the same degree of business risk, right? And third one is the all investors have the same expectations of the firm's net operating income (EBIT) with which to evaluate the value of the firm. Okay, the investors will have the same expectations of a firm's EBIT, right? What about the EBIT? Earning before interest and tax, and you can easily calculate the value of the firm by considering the EBIT of the firm. And the dividend payout ratio is the 100%. As I told you that nothing is retained with the company in the form of the profit. Entire profit is distributed, right, to the shareholders in the form of the dividend. It means you can say that the payout ratio is 100%. Okay, and there are no corporate taxes. Okay, so this is again the assumption that there are no corporate taxes. So by considering these assumptions of the MM approach, you can easily apply this particular theory towards your capital structure decision. So there are different theories we talked about in today's session. So I think now you are familiar with the theories, and you should be familiar with the different terms of the financial management. And I would like to say that this is very important topic, because now when the companies or when the finance managers are having the responsibility on their shoulders to increase the profitability in the firm, or they want to attract more investors towards making the investment in the firm. So that time we need to develop a particular capital structure, and we should think whether the organization should work on the leverage, or they should use the high debt capital along with the equity capital, and what kind of the decision should be taken by the finance manager if they are playing a vital role in the company to make the capital structure decision. So on the basis of these theories, right, we have to focus on the capital structure decision. And capital structure decision can be taken on the basis of the value of the firm. Again, I would like to emphasize on the 2 or 3 points that are very important when you are taking the decision regarding capital structure decision. So if you are building the capital structure, right, the proportion of all the resources you are using to raise the fund from the market, So if you are using the different kinds of the capital in the forms of the preference shares, equity shares, and the debt capital, as known as the cheaper form of the capital. So if you want to reduce the overall cost of capital, if you want to attract more investors in your company, if you want to increase the value of the firm in the market, so that time you need to focus on a particular theory, and different theories are there. Few theories or any theory is describing that we should not go for taking the decision on the basis of the value of the firm and the overall weighted average cost of capital, because there is no any change when we are changing the capital structure of a company. And another theory is having the different point of view, that if we are using the debt capital and we are using higher debt capital along with the equity capital, there would be an impact on the capital structure, and there would be an impact on the value of the firm, and there would be impact on the overall weighted average cost of capital, and the company can use these theories for making the more profitability, for increasing the shareholders' wealth. So I think today's session is very fruitful for you all when it comes to understand the concept of the capital structure theories. In the next session, we would cover the more concepts of the financial management. And thank you.